In the ride-hailing services industry, there's Uber and everyone else. The company's scale is unrivaled, and its financial results no longer resemble a risky startup. Uber just published its Q1 report, showing 17% constant currency revenue growth and $2.3 billion in free cash flow this quarter alone. If its growth plans come to fruition, its annual free cash flow could reach $13 billion in 2026. This might make investors wonder if the stock isn't actually a bargain right now, given the company's $180 billion market cap. We were thinking the same thing, but two things are stopping us from buying right away. The first is that ride-sharing and the taxi business in general is very cyclical. People simply ride less when the economy is weak. Even the mild economic deceleration we saw in 2022 caused a two-thirds decline in Uber's valuation. JP Morgan recently raised the probability of a U.S. recession in 2025 to 60%, which doesn't bode well for cyclical companies. And the second reason why we don't worry about missing out on the stock is this Elliot Wave chart. It reveals two 5-wave impulses interrupted by that 2022 bear market in between. The first one is marked 1, 2, 3, 4, 5 in Roman numerals, where the 5 subwaves of wave 3 are also visible. The second one is labeled 1, 2, 3, 4, 5 in brackets, where 2 lower degrees of the trend are recognizable within wave 3, and wave 4 is a triangle correction. Given Uber's strong fundamentals and long growth runway, we think that these patterns stand for a sequence of first and second waves of a much bigger future uptrend. That being said, every impulse is followed by a correction, and this applies to the current wave 1 as well. Not to mention that triangles precede the final wave of a larger structure. Here, the final wave is 5, and it is likely to be entirely erased by wave 2, before the bulls can return in wave 3 of 3. Assuming a bearish reversal near $100 a share, that'll be a 40% decline back to the support just under $60. We plan to take advantage of it to add Uber to our stock portfolio, but as of this writing, we see no reason to hurry.